Hi guys, welcome to accounting. I wanted to review what we had done last week on debits and credits. I wanted you to keep this in your mind before we started today's assignment. This joining the pieces, chapter 2 review, is in your helpful resources section under joining the pieces if you want to refer back to it. It's always there for you. I wanted to remind you that total debits equal total credits. And we were talking about debits and credits and a T account earlier last week. So, if you want to review on the T account, right here is a T. It just looks just like the letter T. The name of the account goes at the top of the T. Now the left side of the T account is called the debit side, and all debit means is on the left. The right side of the account is the credit side, and all credit means is enter it on the right side. Now remember our accounting equation that assets equals liabilities plus owner's equity. So the same is true in a T account. Your debits have to equal your credits. If you put a debit on one account, you will put a credit on another account. So let's review on the types of accounts. Assets are on the left side of the accounting equation, and the debit is on the left side. So asset accounts have a normal debit balance. They are increased on the left, and they are decreased on the right by a credit. On the other side, liability accounts have a normal credit balance, and they are increased by a credit. They are decreased by a debit. Your capital accounts are the same way as a liability account. They have a normal credit balance, and they are increased by a credit entry or an entry on the right side. They are decreased by a debit entry. So if you think of what goes into the capital accounts, remember we have revenue accounts, and we have expense accounts, and the drawing account. Those are the three types of accounts that impact capital. Let's go back to revenue. A revenue account has a normal credit balance. So credits increase revenue. Debits decrease revenue. On the other side, expense accounts have a normal debit balance, so debits increase them and credits decrease them. The drawing account is the same way. It has a normal debit balance, so debits increase the drawing account and credits decrease the drawing account. Okay, so now let's look at an example of T accounts. Here is a review quiz that's shown in your textbook, and I just copied it over as a review. But on the directions here, it says on plain paper, draw T accounts and record the following transactions and identify each transaction by letter. So that's what we will do. There are 5 transactions here. The first one, Greg Calloway invested $8,000 in a new business to be called Callaway Electronics. So we know that this is an owner investment and he has invested cash. So we are going to identify our transactions by the letter because this is transaction A. So we know that this transaction increased cash and it also increased capital. So you can see here we have drawn a T account for cash. So we've labeled this one cash. And since cash has a normal debit balance, we are increasing cash on the debit side, on the left side. So here is our transaction identification, the letter A, and we increase it $8,000. And you know that for every debit you have to have a credit. So the other account impacted by this transaction is Greg Calloway Capital. So we've drawn a T account. We have labeled it Greg Calloway Capital, And capital accounts have a normal credit balance, so they increase on the credit side or the right side. So the other half of transaction A is an $8,000 credit to Greg Calloway Capital. And you see we have it, the letter A identifies it, and then here is the amount on the right side or the credit side of the T account. That's all you need to do with the first transaction. The second transaction, transaction B, purchased equipment on account $1,200. Okay, we know that it impacts the account equipment, and it says on account, so that is accounts payable because we did not spend cash on it right now. We're going to pay for it in the future because we purchased it on account. So we are going to increase equipment because equipment is an asset. So we have created a T account called equipment. We have identified the transaction by the letter B, and we are making a debit entry because equipment is an asset. It has a normal debit balance. So we are making the entry on the debit side to increase it $1,200. We know that we purchased the equipment on account, so we have to create a credit somewhere, and that will be in accounts payable because accounts payable has a normal credit balance. We are increasing it by a credit entry of $1,200, and you see we have identified it with the letter B. Notice that our T account is labeled accounts payable. Now, letter C, we purchased office supplies for cash, $500. Okay, we know the two accounts are office supplies and cash. If we purchase office supplies, we're going to increase them, and we paid with cash, so we decrease cash. So here's our two accounts. So the first one we're going to do is we're going to create an account called office supplies, and that has been done for us here. It's transaction C, and we are increasing it by $500. Office supplies is an asset. It has a normal debit balance, so we are entering it on the debit side because we're increasing it. Now we paid cash for it, so we have to decrease cash. So here is the second half of the entry. It's a credit to cash because we are decreasing. Cash is an asset, so to decrease it, we have to credit it. So you see here, we've made a credit entry of $500 to cash, and that is transaction C. Now, transaction D, purchased shop supplies on account, $300. Okay, let's look at the two accounts that are impacted. Shop supplies is one of them, and we purchased it on account, so we're going to be using accounts payable again. So we purchased shop supplies. Those are increasing. We're creating a T account called shop supplies. Shop supplies is an asset. It has a normal debit balance, so we are entering it on the debit side to increase it. And notice we have labeled it the letter D to identify our transaction. And the credit entry is we bought it on account, so we're increasing accounts payable. Notice the letter D identifies our transaction and the amount. Remember, accounts payable has a normal credit balance, and to increase it, we must make a credit balance. And remember, credit is just entering it on the right side of the T account. Now, and finally, our last transaction, E, paid $600 on equipment purchased in transaction B. Well, let's go back and look at transaction B. We know we've paid $600, so we know that cash is involved, since the word paid is in it. So transaction B is we purchased equipment on account, $1,200. So we are paying on our debt. So transaction E, we're going to pay, so cash is part of it, and we're paying on equipment. So we're not buying equipment again. We're paying on our debt. So notice accounts payable, it has a normal credit balance. So we need to reduce our debt by $600. So we're making a debit entry this time because we want to reduce the amount in the account. Notice we've identified the transaction by the letter, and we're entering $600 on the debit or left side of accounts payable, and that will reduce it. Now we're also reducing cash, so our credit entry this time is going to be for cash because it's the other part of the entry, and we are identifying it by transaction E and $600 credit. We're entering it on the credit side because remember cash has a normal debit balance and we need to reduce it. So we are making a credit to cash. So both of these accounts are being reduced, one by a debit and one by a credit. A couple things you need to keep in mind when you are doing transactions, recording them on T accounts. Make sure that you are identifying them by the number or letter of the transaction, and make sure that you're entering it on the proper side. Remember, for every debit you have a credit. So for example, here all of this is $8,000 and then you have an $8,000 credit. So make sure you have a debit and a credit for each transaction, and make sure each transaction is identified by its letter. You're going to have an opportunity to do this for yourself in your practice for today. The way you're going to be doing it, you're going to be drawing your own T accounts. So make sure that you draw them clearly. There'll be one T account for each account, just like this one, and make sure that you write clearly so I can see the numbers. And after you're finished, you're going to take a picture and then you are going to upload it to your assignment.